So for this session, we will tackle IAS 34 or Interim Financial Reporting. IAS 34 prescribes the minimum content of an interim financial report and the recognition and measurement principles in complete or condensed financial statements for an interim period. IAS 34 does not mandate which entities should produce interim financial reports. IAS 34 is applied when an entity chooses or is required by the government or other institution to publish interim financial report that complies with IFRS. IAS 34, however, encourages publicly listed entities to provide at least semi-annual financial report for the first half of the year to be issued not later than 60 days after the end of the interim period. Under the reporting requirements of the revised Securities Act in the Philippines, the Securities and Exchange Commission or SEC and the Philippine Stock Exchange or PSE require certain entities to provide quarterly financial reports within 45 days after the end of each of the first 3 quarters. Similarly, the SEC requires entities covered under the Rules of Commercial Paper and Financing Act to file quarterly financial reports within 45 days after each quarter end. Financial reports, whether annual or interim, are evaluated for conformity to the IFRS on their own. Non-preparation of interim reports or non-compliance with IAS 34 does not necessarily prevent the entity's annual financial statements from conforming to the standards. An interim financial report is a financial report prepared for an interim period and contains either a complete set of financial statements as described in IAS 1 or a set of condensed financial statements as described in IAS 34. Interim period is a financial reporting period shorter than a full financial year. An entity presenting an interim financial report has the option of applying either IAS 1 or IAS 34. The entity applies IAS 1 if it opts to provide a complete set of financial statements in its interim financial report. The entity applies IAS 34 if it opts to provide a condensed set of financial statements in its interim financial report. So IAS 1, again, you should provide complete set of financial statements, and the complete set of financial statements are the statement of financial position, the statement of profit or loss and other comprehensive income, statement of changes in equity, statement of cash flows, explanatory notes, additional additional statement of financial position which is required only when certain instances occur. For IAS 34, the condensed set of FS is composed of first, your condensed statement of financial position, second, your condensed statement of profit or loss and other comprehensive income, third, your condensed statement of changes in equity, fourth, your condensed statement of cash flows, and last, your selected explanatory notes. An entity is not prohibited or discouraged from preparing a complete set of financial statements for its interim financial reporting. However, in view of timeliness and cost considerations, and to avoid repetition of information previously reported, an entity may be required or elect to provide less information at interim dates as compared with its annual financial statements. In such case, the entity applies IAS 34 to provide a set of condensed financial statements. Condensed means that the entity need only provide the minimum information under IAS 34. At a minimum, condensed interim financial statements include each of the headings and subtotals that were included in the entity's most recent annual financial statements and the selected explanatory notes required by IAS 34. Additional line items or notes are provided if their omission makes the condensed financial statements misleading. Interim reports are intended to provide an update on the latest complete set of annual financial statements. Hence, they focus on providing information on significant events and transactions that have occurred since the latest annual period, rather than duplicating previously reported information or providing relatively insignificant updates on them. Consequently, users of Interim Financial Report are assumed to also have access to the entity's latest annual financial report. So below are your examples of events and transactions for which disclosures would be required if they are significant. You have your A to G. And here your H to M. When an event or transaction is significant to an understanding of the changes in entity's financial position or performance since the last annual reporting period, its interim financial report should provide an explanation of and an update to the relevant information included in the financial statements of the last annual reporting period. So here are your other disclosures, in addition to the significant events and transactions from the previous slide, continued by this. So periods for which interim financial statements are required to be presented here. Interim reports shall include interim financial statements, condensed or complete, for period as follows. First, your statement of financial position as of the end of the current interim period, and the comparative statement of financial position as of the end of the immediately preceding financial year. Next, your statement of profit or loss and other comprehensive income for the current interim period and cumulatively for the current financial year to date, with comparative statement of profit or loss and other comprehensive income for the comparable interim periods, your current and your year to date, of the immediately preceding financial year. As permitted by IAS 1, an interim report may present for each period statement or statements of profit or loss and OCI. Your statement of changes in equity cumulatively for the current financial year to date, with a comparative statement for the comparable year to date period of the immediately preceding financial year. And last, your statement of cash flows cumulatively for the current financial year to date, and the comparative statement for the comparable year to date period of the immediately preceding financial year. So we will discuss this in the later slides. Materiality judgments on recognition, classification, and disclosure of items in the interim financial report are assessed in relation to the interim period financial data and not forecasted annual data. IAS 34 recognizes that interim measurements may rely on estimates to a greater extent than measurements of annual financial data. The same accounting policies are used in interim reports as those used in annual reports, except for accounting policy changes made after the date of the most recent annual financial statements that are able to reflect in the next annual financial statements. Revenues that are received seasonally, cyclically, or occasionally are not anticipated or deferred in the interim period if anticipation or deferral is also not appropriate at the end of the annual period. Examples include your dividend revenue, royalties, and other government grants. Such revenues are recognized when they occur. Costs that are incurred unevenly during a financial year are anticipated or deferred in the interim period only if it is also appropriate to anticipate or defer them at the end of the financial year. So, presented here is your semi-annual interim financial reporting. So, if the if an entity follows a policy of reporting half-yearly financial reporting, This would be your this would be the content of your interim financial statement. So take note that for the balance sheet or statement of financial position, your the current balances should reflect your half year or your June 30, 2020 if it is using calendar year. Okay? And your comparative period should be the um, end of the previous reporting period. Okay? So why do we use the December 31, 2019 for balance sheet, and why do we not use June 30, 2019 similar to the other statements? It is because for balance sheet um, if you notice the balance sheet, it is termed as statement of financial position as of. So it means a cumulative amount. Okay, so it is not appropriate to have a comparative data for balance sheet having it dated as June 30, 2019, or it should be the as of date. Okay, so for a statement of financial position, or sorry, for a statement of financial performance and OCI, as well as your statement of changes equity and cash flows, the current year would be June 30, 2020, and your comparative period would be the um, the comparative the year to date um, figure two. So it should match with the current period. So let's say that the um, an a, a company is operating at a fiscal period. Let's say that their operations starts at March 1. Okay, so their half year would be September 30. So their comparative period should be the current period should be September 30, 2020, while their comparative period should be September 30, 2019. Okay? So in this given example, the one flash in your screen, this is a calendar year method. Okay? So take note, you should be familiar what is a fiscal period. So for quarterly reporting, that second quarter interim report for period ending June 30, 2020. Same concept applies with the half year reporting, but in your statement of comprehensive income or your income statement, there should be a note, there should be amount presented for your 3 months ended, okay, for your January to March 31, as well as your for 6 months ended, which is your January 1 to June 30. So let's now proceed with the um, problems. So first problem, X company had the following transactions during the year. We have here your loss from typhoon amounting to 700K, loss from inventory write down at 500K, loss from disposal of a business segment 1 million, and payment of insurance premium for calendar year 100,000. So we are asked on the total amount of expenses that should be included in the income statement for the first quarter. So let's identify first the following transactions. Loss from typhoon. Can we consider this as independent transaction for the first quarter, or should this be spread out for the entire year? Loss from typhoon. Yes, this is an independent transaction happening on first quarter. Hence, the whole amount for the loss from typhoon amounting to 700K shall be included as expense. Second, your loss from inventory write down. Is this an independent transaction for the first quarter, or should this be spread out for the entire year? Also similar with the concept from loss from typhoon, this is a independent transaction. Hence, the 500K should be reported, the whole amount of 500K should be reported in the income statement. Third, your loss from disposal of business segment. Is this a um, independent transaction, or should this be allocated for 12 months? Again, similar with the first two transactions, this is an independent event or transaction. Hence, this should be recorded in the income statement for the first quarter. And last, you have here payment of insurance premium for calendar year amounting to 100K. Is this an independent transaction for the first quarter, or shall this be allocated for 4 quarters or for 12 months? Okay, so this is the only difference among the three transactions. Since there is a statement here that the payment of insurance premium for calendar year, it is safe to assume that the the insurance premium would be expensed every quarter. So for a year, there are 4 quarters. So you have to divide. I will now flash the answer. You will now divide 100,000 divided by 4 quarters. That would give you 25,000, and that would be now your insurance expense for the quarter. Okay, so it means that you still have 75,000 worth of insurance premium for quarter 2 to quarter 4. Understood? Under IAS 34, the general rule in preparing interim financial statements is that costs and expenses that clearly benefit more than one interim period are allocated to the interim periods affected. Thus, the insurance premium of 100,000 is allocated over 4 quarterly interim periods. Gains and losses are not allocated over the interim periods. Thus, the loss from typhoon, loss from inventory write-down, and loss from disposal of a business segment are reported in the quarter when incurred. Inventories shall be measured at the lower of cost and net realizable value, even for interim purposes. Accordingly, if the net realizable value is lower than cost, a loss on inventory write-down shall be recognized regardless of whether the write-down is temporary or non-temporary. Next question. Fiji has historically reported bad debts expense of 5% of sales in each quarter. For the current year, the entity followed the same procedure in the 3 quarters of the year. So you have here sales for Q1, you have 2 million, for Q2 1.5 million, for Q3 2.5 million, for Q4 you have 4 million. However, in fourth quarter, the entity determined that the bad debt expense for the entire year should be 450,000. What amount of bad debt expense should be recognized for the fourth quarter? Okay. So guys, what would be your approach here? Okay, so if there is no statement regarding that the bad debt expense for that if there's no note that the bad debt expense would be 450,000 for the entire year, what you would simply do is multiply 5% with the quarterly sales. Okay? That would be your answer. Okay? However, again, there's a caveat here that the bad debt expense is already determined for the whole year, and that the bad debt expense should be 450,000, and you only knew it for the fourth quarter. Hence, for quarters 1, 2, and 3, you were already able to recognize and record bad debts expense relating to that quarter. So what would you do now? Okay, so you would squeeze the amount, you will work back. How would you do it? This one. Okay, so what you have to do first is to plot the bad debts expense for the year amounting to 450,000. Okay, because that is now your true amount of bad debts expense. And from there, you subtract the bad debt expense recognized for quarters 1, 2, and 3, amounting to 300,000. For quarter 1, you were able to get your bad debt expense by multiplying 5 million, by multiplying 5% to 2 million. For Q2, 5% to 1.5 million. And for Q3, 5% to 2.5 million. Okay? So for Q1, your bad debt expense is 100,000. For your Q2, bad debt expense is 75K. While for Q3, bad debt expense is 125K. Okay? Again, if there is no note here, or there is no, it is not stated that bad debt expense um, is already given for the final amount of 450K, you would just simply multiply 4 million by 5%. But then again, the company has already evaluated and approved and finalized that the budget expense for the year should be 450K. Hence, you would subtract 450K with the budget expense recognized for the first 3 quarters amounting to 300,000, and 450K less 300K, that would be 150,000, and that would be your bad debts expense for the fourth quarter. Okay, good. So last problem. Okay. So similar with problem 2, um, Apple Co. Apple Company, a calendar year entity, reported the following income before income tax and effective tax rate for the first 3 quarters of the current year. So for quarters 1, 2, and 3, your income before tax are 6 million, 7 million, and 8 million respectively, with an effective tax rate for quarters 1 and 2 of 30%. However, for quarter 3, the effective tax rate was amended to 25%. So we are now asked for the income tax expense for quarters 1, 2, and 3. Again, as I've said, this is similar with problem 2, because if there has been no changes, okay, because in problem 2, um, there is the entity already determined the budget expense for the year amounting to 450K. Again, if that information is not available, you would just simply multiply 5% to the Q4 sales. Okay, so similar with this one, the effective tax rate for Q3 has changed. Hence, you would need again to reassess your income tax expense for the 3 quarters ending. Okay, because again, if the effective tax rate did not change for quarter 3, you would just simply multiply 8 million with 30%. But again, that is not the case. So let's now compute for the income tax expense for Q1. For Q1, the effective tax rate of 30% multiplied by your income before tax of 6 million, that would give you 1.8 million. For quarter 2, effective tax rate of 30% multiplied by your income before tax of 7 million, that would give you 2.1 million. So you already have an accumulated income tax expense of 1.8 million plus 2.1 million. You already have 3.9 million worth of income tax expense as of quarter 2. Okay? So for quarter 3, again, the effective tax rate has changed. Hence, you need to reassess it again from the beginning, from quarter 1. You are required now to assume that the effective tax rate is 25% since quarter 1. Okay, I will now plot the answers. There. You might be wondering, sir, why is it that the effective tax rate of 25%, which was just changed for quarter 3, sorry, which was just changed in quarter 3, why is it also applied for the first 2 quarters? Because again, effective tax rate are statutory requirements. So these are government mandated. Okay, this is not a company policy, and but this is the law. So we have to apply it from the very beginning or retrospectively. Okay? So again, as I've said, if there has been no changes in the effective tax rate, just multiply the total of the income before tax for the 3 quarters and multiply it by 30%, and you would get your total income tax expense. However, since there has been changes in the effective tax rates for this year, you would need to multiply 25% for all quarters. Okay? So get your total income before tax, 6 million plus 7 million plus 8 million. You have 21 million here, multiplied by your new effective tax rate of 25%. That would give you 5,250,000. That is now your total income tax expense for the 3 quarters. But then again, the question is, what is the income tax expense for Q3? So now you just need to simply deduct your income tax expense recognized for quarters 1 and quarter 2. That is minus 3.9 million. Your quarter 3 income tax expense is 1.35 million.